Welcome to the Transparent FX Academy. My name is Nick and I'm a top podder on TradingView. And as a top podder, today I'm going to show you exactly how you can become a profitable trader by exploiting multi-time frame technical analysis and order flow. Now, without wasting any more time, let's get straight in the charts to find some good trading opportunities. Okay, so I definitely wanted to speak about USDJPY in preparation for this trading week because it is a very interesting pair both from a technical and in order flow perspective to speak about. In fact, we will see what hedge funds have been doing on the JPY during the election week. Definitely very interesting data that we can see here from the new report that just came out on Friday. So definitely interesting pair to speak about. So in this full analysis, we will first be speaking about this market from a technical perspective, then from an order flow perspective. And by the end of the video, by using the combination of these two different types of analysis, we will see exactly what kind of trading opportunity we can be looking for on USDJPY to obviously be capitalizing on the pair. And as usual, I will keep the analysis as educational as possible so that you will learn some very important concepts when it comes to developing a strategy and obviously implementing it in the market. So let's perform the full breakdown. Let's, as usual, start from the monthly time frame. Now, from a monthly perspective, what we can currently see on USDJPY is that we are currently breaking below a quite important structure area. In fact, this zone was acting as extremely strong demand here, again as very strong demand and support here, again here, again here, and currently the market has been breaking below this very strong support area. So finally, this is the first time that we see a close below this very important monthly support area that we have seen with the last monthly close that we have, which is obviously from last month, as we can see. And in this current month that we are trading in, we have already seen the market retest its zone and get rejected to the downside quite aggressively. So on the monthly, we can see that we are breaking below an extremely strong support area, which at that point, if we will see another monthly close below the area, will be confirmed as extremely strong resistance because previous support, once it is broken to the downside, it is turned resistance. Going down on the weekly, what do we see? Now, from a weekly perspective situation, it is quite clear as well. We have a market that is providing a very strong impulse to the downside, creating a lower low, and this weekly close that has just been created. With the weekly close that the market is creating here, will have broken another structure support area from a weekly perspective, because on the weekly, this is previous weekly support, which now that it is broken to the downside, is turned weekly resistance. So we have previous weekly support, turn resistance, which the market should now go and retest before creating a continuation to the downside. Another thing that we can see is that in general, after an impulse in the market, if you want to measure the correction, what you have to do is take your Fibonacci from the high to the low of the impulse. And what we can see is that at the moment, it's 0.382 of the Fibonacci taken on this weekly impulse is lining up perfectly with the previous support, not on resistance, creating a confluence of resistance area inside of which the market should be attracted to grab some liquidity before creating the continuation to the downside. In fact, no market always just moves in a straight line. This is just a general concept that I want to speak about. No market always moves in a straight line. Why during a trend, you will always have retracements on the lower timeframes. You will always have retracements because the market needs to go and grab some liquidity before creating new continuations to the downside. So what hedge funds do, they start this retracement so that most retail traders, they will start buying so that they can use their buying during the retracement to actually sell and create the continuation to the downside. In fact, most trend continuations are actually fueled by hedge funds that continuously pour money inside of the market. This is just a general concept. So we definitely do expect a retracement, and after the retracement, we can expect the continuation to the downside. Going on the daily, what do we see? Now, from a daily perspective, situation is extremely clear as well. Let's keep the charts clean. Now, on the daily time frame, what do we see? Now, first of all, we had spoken about USDJPY quite a few times in the past. We spoke about USDJPY after the market had provided this overextended M formation. And after an overextended M formation, you want to see the market create a retracement to go and complete the pattern in the zone that is in between the start of the pattern and the neckline. So basically this area here. And we wanted to see the market go and complete the pattern. So in this case, with this overextended M formation here, we wanted to see the market go and complete the pattern inside of this zone, which is exactly what the market did. And I will link in description the previous analysis in which I explained all the reasons for which, when the market was here, we wanted to see the market create this move to the upside. Then, after the market had created this impulse to the downside, I made another breakdown on this pair, explaining all the reasons for which we wanted to see a retracement before the continuation to the downside for the creation of a lower low. And again, that is exactly what the market did, and I will link again also this previous analysis in description so you can go and check it out for further reference and more free education. But at the moment, what do we see? Just a quick reminder, make sure you comment below and you let me know which pair or topic you would like me to cover or analyze in the next video. Now, at the moment, what we can see is that the market has just provided this very strong impulse to the downside. And after an impulse, what you want to see, as we have already explained, we want to see the market give us a retracement specifically. Also here, from a daily perspective, we can see that the market has broken massive structure. In fact, this zone from a daily perspective was acting as strong daily support here, again daily support here, again daily support here, again daily support here, and again daily support here, which is now turned resistance. Why it is turned resistance? Because the market has broken below the area with this strong impulse. Now, we don't know if the retracement to this area will start immediately from here, or if the market will continue to the downside before starting the retracement. That we still don't know. But if the market will start the retracement from here, what we can do is take our Fibonacci from the high to the low of the impulse. And if the market will start the retracement, then what we can see is that the 0.382 is lining up perfectly with the low of this previous support, which is now turned resistance. So what we actually have here is the confluence of resistance inside of this zone in between the 0.32 and 50% retracement of the Fibonacci taken on the impulse. A confluence of previous support, now turned resistance, inside of this area given by the 0.32, 50% and previous structure support, which is now turned structure resistance, from which we can expect the market to go and grab some liquidity and get strongly rejected to the downside. So overall, on the daily, situation is quite clear. What we would like to see is the market go and grab some liquidity inside of here before creating the continuation to the downside. Now, before I show you how we will be approaching this kind of situation that we have from a technical perspective with students, let's first go and give a quick check at what we have from a COT perspective. So commitment of traders, which is what hedge funds are currently doing in the market. Now, if we go and see what we have from a JPY perspective, so what hedge funds are doing on the JPY, what we're actually checking is not the JPY. What we're actually checking is JPY USD. Now, the reason for which we are actually checking JPY USD is that all currencies on the spot are traded against the USD. So if you actually check the data for the JPY, what you are really checking is JPY USD. But if you want to check USDJPY, what you have to do is actually reverse everything that you see here on this data. So what we can see here is that with the last report, hedge funds have opened 4.8k long positions on JPY USD, meaning that they actually opened 4.8k shorts on USDJPY. So hedge funds have been shorting USDJPY, which is clearly reflected also in the price action. And if we go and see what they did from a shorting perspective on JPY USD, we can see that they closed 5.3k short positions. However, since we have to reverse everything, this means that actually what they did is close all these shorts, so 5.3k longs getting closed, because obviously you have to reverse everything. So what actually happened is that hedge funds closed 5.3k long positions and opened 4K shorts. So they have been closing their longs and opening massive shorts on USDJPY. And in fact, this is already reflected in the price action. In fact, the market followed to the downside with a strong rejection. And what actually happens most of the times, the way in which they probably play this out is using the volatility given by the elections to actually create this spike that helped manipulate the market and hunt all the stop losses and trap a lot of people's in longs so that they could actually add these massive short positions, 4.8K shorts, and close these longs. And that is in fact exactly what the market did, follow to the downside quite aggressively. Now, since we can see that net positions were increased from 17 to 28K, we can definitely expect more continuation of the bearish momentum of USDJPY. So how we will be approaching this with students? Now, as usual, trading is reactive, it is not predictive. And the monthly, weekly, and daily timeframes combined with the COT data are the best timeframes when it comes to the directional aspect of the market. But the best timeframe when it comes to confirmations and entries is the 4 hours. So what we will be doing with students is waiting for the market to create a retracement. Now we have no confirmation that the market will actually create a retracement. The market could easily continue to the downside and then start a retracement. But if the market will start a retracement next week and go and retest this structure exactly inside of this area, this is where we will be monitoring price action from a 4-hour perspective with students. And we will be waiting for the market to shift from a bullish market as it will be from a 4-hour perspective to a bearish market. And as soon as the market in the side of this area will shift from a bullish to a bearish market and provide to us one of our valid entries with students, at that point, we will be taking a nice short with a very good risk to reward and very good probabilities for the move to the downside and completion of this impulse, correction, and impulse pattern to the downside. If you enjoyed the video, make sure you smash that like button and comment below. It really does support the creation of more free analysis and education for all of you. Also, make sure you go and check out the mentorship program. You find the link in the description. It's a very complete program. You first learn all the rules of my rule-based strategies, and then you trade them live with me. Each and every day you get a new daily market breakdown showing you exactly how to apply the strategies with entries, stops, and take profits, as well as having me answering every single question that you have every day. So it's a very complete program. I really suggest that you go and check it out. The link is in the description, and I will see you in the next video.